Hey, hi there. It's Neil Christiansen, and welcome back to another episode of the Mile High Market Talk podcast, where we bring local professionals to the stage and have them share their expertise and to educate those who are looking to build their overall wealth. In today's episode, we're going to unpack what I think could be perhaps one of the most unique ways one should be approached or approaching financial planning is principle-based financial planning. So we're going to go over a few of the principles and kind of go a little bit deeper with all of them to give a idea of what they really mean and how one could actually set up a very good financial plan going forward. Today, I'd like to introduce our local guest, Eric Chatterley with Unique Advantage. Interesting thing about Eric is he hasn't always been a financial planner. He was actually a dentist, owned his own practice for about 14, 15 years, but saw some opportunity with just in the industry of how he could potentially transition over to the financial planning side, utilizing these principles and help some of his colleagues be better prepared for retirement. Eric he enjoys the outdoors. He does a lot of rock climbing and so forth, and he enjoys hanging out with his wife as well as his 5 kids. So without further ado, I'd like to just quickly introduce Eric. Eric, how are you doing today?
Good, Neil. Thank you for that introduction. I appreciate that.
Absolutely. Absolutely. Well, I think we're going to have just some great tidbits for those that are either entering retirement, or I should say, really entering retirement planning, and just maybe they're not as satisfied as they thought they were with their current plan, and how can they improve it? As I said, these are the principle-based financial planning processes and so forth that we want to discuss. And so, Eric, let's go ahead and just kind of start from the top here. Unique Advantage has the first one to be you want to save 15% or more of your total income. Can you dive into that a little bit further for us?
Yeah, I guess maybe a little bit before we kind of jump into that principle is, I guess, first understanding that the ultimate goal that we're trying to help our clients achieve is financial freedom, which is different than what we look at when we're actually striving for what most people are looking to do, which is retire. And so we really want to be able to help our clients understand what financial freedom is, why they want to achieve that. And then these principles will be a guide for them. It's kind of like going bumper bowling. You know, when you go bumper bowling, you have those bumpers in place, which, prevent you from having your ball go into the gutter. But it doesn't necessarily mean you're going to get a strike every time. And that's what these principles do for our clients is they help make sure that that ball always stays in the lane and knocks down some pins. And sometimes you might get a strike, but we want to give our clients an opportunity to succeed under the most number of circumstances possible that they might encounter in their lives. And so when we look at this first principle, save 15% or more of your total income, this is one of the most important principles, but it's also, interestingly, one of the most challenging principles for most people. Right now, there's about 40% of the people in our country cannot afford an unexpected expense of $1,000 or more, which is kind of crazy to think about that. And if you think about what we call unproductive debt or credit card debt, it's the highest it's ever been in the history of our country. And so this is a very important principle that we find, and it kind of ties in with these other principles as well too, specifically principle number 4, which we'll talk about as well. But we want people to be able to build up an income storage to offer some protection in case there's any sort of unexpected events that occur in their lives. And so most people that are saving, they tend to do so automatically in something like a retirement account. But the problem with that is that it's not something that is easily accessible or liquid or guaranteed. And so when we talk about saving, and we'll talk about this in principle 4, we always encourage people to save in something that is liquid, accessible, and guaranteed. And so why 15%? I don't think there's any specific science behind this other than if you think about what that does for you, the more you save, the quicker you can offer yourself that protection, but also take advantage of opportunities down the road as well too. So one of the most important aspects of saving 15% is to make sure that you set up something that is systematic and automatic. And so you don't have to think about it. And so we always encourage putting that into place to make sure that happens on a consistent basis.
With the 15%, and I understand part of that needs to be liquid. What would you say of the 15% should be liquid versus putting it into kind of a 401k or some sort of retirement plan?
So this is where you'll notice a definite difference in what we recommend and talk about as far as saving money, investing money. When we talk about saving 15%, we're talking about saving all 15% of that into something that is liquid, accessible, and guaranteed. And we'll talk a little bit more about financial institutions. Well, maybe this is a good time to do that. But when you think about the rules of financial institutions, what do you think financial institutions want most from their clients?
I think probably consistency of giving them money so that they can reinvest themselves
Exactly. They want our money and they want it as consistent as possible. And how long do you think they want to hold on to that money for?
as long as possible,
Yeah. And how much do you think they want to pay back at the end of it all?
as little as possible.
Exactly. And so, but what do you think they're doing with that money? Do you think they're doing the same thing that they're telling us to do?
Oh, absolutely not. It's the arbitrage, right? They're taking our monies and lending it out at a much higher interest rate for them to make money is, I mean, that's kind of what a bank does, right?
Yeah, yeah, exactly. And so when we're talking about saving this money, we want to make sure our clients maintain use and control of that money to be able to do the things they want to do with that money. And we'll talk more about that in principle number 5 as well too. But it's really important that they understand that that liquidity is essential not only for their protection, but also for investment opportunities. And one of the differences when we talk about investing is a little different than what most people think. Most people think investing is something like a retirement account or stocks, bonds, mutual funds, things of that nature. Our definition of investing is putting your money into something that you have use and control over and you have knowledge about. So you're investing in things that you know and you can control. And that's one of the major differentiating factors between what we teach our clients and maybe what they might hear elsewhere. And so, and we'll kind of, as we go through these principles, we'll kind of tie them all together to see how it all works when we follow all 5 of them together.
Yeah, I think Warren Buffett said, invest in what you know. And he's done pretty good from the last time I checked. 15%. So just so that I understand, our listeners understand too, is you guys are really advocating that one should have 15% saved up before income, I should say their income saved up before they even start putting money away in like a 401k or some form of retirement plan. Is that accurate?
That is accurate. I would say that with the principles that we teach and when people understand them, they'll realize that when we talk about the accumulation theory, which is what is used when we think about investing in a retirement account, when we actually run those numbers for them to see if it actually will work, we show our clients firsthand, and we can even use their financial information as an example, prove that if you're investing in something like that, the system does not work like they say that it will. And so we probably don't have time to go into the details of that today. Maybe that's a future podcast, but we run some great illustrations that show that was what we're doing actually going to work. And we'll show the reasons why we suggest doing something different with their money than potentially investing in retirement accounts.
Okay. So if somebody makes 100,000 a year, then you guys would be suggesting to have at least $15,000 in some form of a liquid account. And if it is being invested, the client really should understand what it is that they're investing in. Is that accurate?
That is correct.
Okay.
Yes.
Okay. So once they've kind of developed that, and frankly, if one's on a budget, I wouldn't say that that's easy to attain, but I would say that it's definitely something that a lot of us could probably do over a relatively short period of time. Maybe it takes a couple of years, but now, like you say, you've got some liquidity that if something comes up, you made the mention of that 40% one could not pay for $1,000 expense. At least you're not putting that on debt because you've actually started with the first principle here of saving enough money so that those unexpecteds can be paid for in cash as opposed to incur future debt.
Yeah, that's exactly right.
Okay, so we understand that let's save some money first. So now go into maximum protection. Well, what does that mean?
Yeah, so maximum protection, before we get into that specifically, when we think about the things that can happen in life, I guess what are some unexpected things that can occur in our lives that could potentially deter us from achieving financial freedom?
Medical, something like that probably is the biggest.
Yeah, so thinking about maybe you're sick or injured, you could be involved in an accident, you could lose a job or have some sort of loss of income, you could experience a death, a lawsuit, experience any type of peril, so flood, fire, anything like that. So when we talk about max protection, we're talking about all the potential unexpected events that can happen in our lives. And I like to use the example of a home, which I think a lot of people can understand. If you were to potentially lose your home to a house fire, how much of your home and your belongings in your home would you want to have replaced?
Well, I would think that if not thinking too much about it, I'd probably want as much of it replaced as I could.
Yeah, so we kind of live based on what we want, not necessarily what we need. And sometimes in the finance world, we talk a lot about needs potentially with our clients. And with our clients, we talk about what you want because we don't live based on our needs. Needs means the bare minimum. Bare minimum would mean you basically have a shelter over your head, you have some food on the table, and not much more than that. But we tend to live based on what we want, right? We have multiple bedrooms, we have probably some decent furniture, some nice belongings, a nice house. And so when we look at maximum protection, we're wanting to protect all of our income assets based on what we want in life. And so some of the things that we essentially kind of go over with our clients is anything from their home insurance, auto insurance, medical insurance, long-term care, disability insurance, life insurance, estate planning, all these different levels of protection that we want to make sure that you're properly protected so that if something does happen, you don't have to dip more into the savings than you need to or go into unproductive debt to be able to overcome that unexpected event.
Yeah, one of the things that comes to mind is what is it, 4 or 5 years ago when up in Superior they had that fire in December and it wiped out a ton of homes. And come to find out that a handful of those folks really never upped any of their homeowners insurance policies. So when they went to go replace it, they didn't have enough to replace those homes. I don't know what they chose to do, if they decided to just pull from other funds in order to support the expense to rebuild, or if they just moved on from it. So, like you say, you don't want to necessarily have to dip into your hard earned savings when you can easily get very affordable protection, whether it's some form of insurance, et cetera, to really make sure that you're keeping as much as you're saving.
Yeah, that's exactly right. And I think a lot of people think that maybe we can be sold too much insurance, but insurance is never going to offer more protection than what the value is of your assets or income. So if you're insuring a home, you can't insure for double the value of what the home is. And they're not going to incentivize a loss like that. And so knowing that, people can understand that it's important to understand what your maximum is and to see the value and what that can do for you if potentially something comes up.
Very good. Okay, so I can kind of see what we're doing here is we're saving some money. We're then going to protect that money. Next principle is fully replacement of assets upon death. Dive into that a little bit further for us.
Yeah, this is an interesting one and sometimes a little bit more challenging to try to explain this so people understand. But I like to use the analogy of a car. So let's say, Neil, you bought a brand new car, and I told you when you get this car, I'm only going to give you one set of tires. How do you think you're going to drive that car?
Probably pretty carefully, since it doesn't sound like once those tires run out, I'm going to have anything to drive on.
Exactly. You only get one set of tires. There's no future replacement of it. So you're going to be very careful about how you use that car and those tires. Now, what if I told you that we were going to put a warranty on those tires and you could definitely replace them once they wear out? How do you think you're going to drive the car now?
So I'll definitely probably experience, for more trips and be comfortable utilizing it, knowing that I'll have the opportunity to replace those tires at some point.
Yeah, exactly. And it's the same thing with somebody gets a paycheck. It comes every 2 weeks or so. Do they tend to use most or all of that paycheck? Yeah, they do. And why is that? It's because they know they're going to get another paycheck coming in another 2 or so weeks. And so this is the principle about fully replacing all of your assets and income upon death. So if something were to happen, we can make sure that we can fully replace everything. But what that does for you is it gives you the opportunity to actually use the wealth that you build and create. You're not afraid to use it anymore. And so this is a really important one to understand, not just for yourself, but also for, let's say you're married or you have children, and you want to make sure they're taken care of. If something, heaven forbid, something happens to you and you pass away, how much do you think you would want to pass on to your wife and kids? And so that's the question we always ask, our clients is, let's say if you knew tomorrow you're going to pass away and you could get life insurance today, how much would you get? And most people are going to say, what? As much as I can get, right?
Mm-hmm.
And so that's the same concept with this is we want to make sure that we are fully protected so that we're not afraid or careful about using our wealth and our assets. We can feel free to use that the way that we want to use it.
Mm-hmm. Mm-hmm. So what's an example then of a product that you might suggest or entertain for a client that would support this principle?
So there's a life insurance in general is really important to make sure you're fully protecting. They actually should call this income and asset insurance. not life
Mhm.
insurance. It's interesting they call it life insurance, but really what that's insuring for is your income and your assets. And so there's different types of life insurance that you can get. We first obviously talked about maximum protection first. So we want to make sure no matter what we do that we get the maximum protection possible to protect all of our income and assets. So not everybody is able to utilize the most efficient life insurance, which is whole life insurance. And what whole life insurance does for you is it first offers the protection that you need, but it also experiences growth within that account over time. So it builds up cash value and it gives you the opportunity to be able to use that cash value however you want to use it.
Mhm.
That what we talked about earlier, which is the fact that it's liquid, accessible, and guaranteed.
Mhm.
And you also have tax advantages that come along with using that type of policy as well too. So there's just different levels that offer different benefits with something like whole life insurance. And so we talk about the strategies that come along with utilizing something like that.
Okay. So the maximum protection, the homeowner's insurance, the medical insurance, and so forth. I mean, those are things that we should all have just in case. But then, like you say, the whole life, universal life, these are products that could be almost a supplement to protect further than what the other insurances and so forth would do. Am I tracking on that right?
Yeah, it just offers additional benefits and it's more efficient with how you're using your money, the benefits that you receive because of that.
Okay. Okay. All right. So at this point, if somebody's following the principles, they've got some savings, they've got protection, they've got even additional protection so that if something was to happen, their family would be protected going forward. Okay. I know that this is always kind of where you were alluding to. Step 4 was maybe part of step 1. Having 6 months, 3 to 6 months is what you typically hear, but you guys are suggesting 6 months or more of income. Dive into that a little bit further for us.
Yeah, so principle 4 is building and maintaining 6 months to a year of income storage. And like we talked about before, we want to make sure this isn't something that's liquid, accessible, and guaranteed. But this is also serves two main purposes. One of them we've talked about, which is unexpected events, right? Anything can happen if you end up, having a loss of income or job. You have a wedding that comes up, whatever it might be, we're trying to avoid going into unproductive debt. We want to be earning interest instead of paying interest. And so it just offers a level of protection to have that savings in place. But the second thing, which is really important, which when we talk about investing, this is what we want to do with our money is when we have a certain amount of liquidity and cash available, we can take advantage of investment opportunities.
Mhm.
And these are things that are only available to those that have cash. And so, for example, if you want to invest in real estate, right, you need to have money you can put down 20, 25%. And oftentimes banks like to see a certain amount of liquidity that's available as well too, if they're going to be lending you money, especially if it's a significant amount of money. Or if you're going to be investing in something like a franchise, you have to have a certain amount of cash available to put down, and they like to see a certain amount of liquidity or a certain income level to be able to invest in a franchise. So those are the two main reasons we want to have income storage is to be able to plan for unexpected events, and then second, to actually invest in things that we know and we can control.
Okay. So would you also suggest to a client where if they do have real estate and they've got a significant amount of equity built up over time, would a HELOC be something that would kind of support this? Or are you saying, no, we would prefer that it's just cash on hand that would not create any type of payment or debt if it was used?
We're talking about cash on hand, although HELOCs can still be a great tool that you can use for opportunities as well too. But the main thing that cash is doing first and foremost is supporting the idea that we want to plan for unexpected events.
Yeah, and I think, not too long ago, 1st of April, there was a fairly sizable dip in the markets, although short term, at least for right now, could have been a great time if somebody had some cash to maybe get into the market and all of a sudden see a fairly healthy return in a relatively short period of time. But it's like, the stock market's funny when it goes on sale, when prices drop, it doesn't seem like anybody ever wants to buy it.
Yeah, well, and it's interesting with the stock market, and something that we want our clients to understand is if they're investing in something like the stock market, you want to make sure you know and understand what you're investing in, right? And so if that's something that you're interested in doing, make sure you understand more about what that means and how to do it properly and effectively before you make that decision. But you're right, it's important to be able to take advantage of those opportunities when they come along.
Yeah. It's one of those things where it's on sale and nobody wants to take advantage of it. It's always kind of funny. All right. So I feel like if one has followed up until this point, they've got a nice little reserve for that kind of this really unexpected happens over the weekend type stuff. They're not going to go into debt. They've got a little cash. They've protected themselves utilizing the things that we should all have, homeowners insurance and medical insurance, et cetera. We've taken it a step further to look at some additional insurance, whether it's life or whole or universal. We've also now set aside anywhere between 6 to 12 months for those opportunities, expected expenses. Maybe if you're getting closer to retirement, I guess those funds could be utilized for any type of drastic drop in real stock prices, to where you're not having to pull at a loss as opposed to a profit. So the last one is the velocity of money. I love the velocity of money. I think it's one of the coolest concepts to really understand. How do you guys explain that to your clients?
Yeah, really, the velocity of money is getting multiple uses out of the same dollar. So when you think about financial institutions, let's say you close on a home that you just purchased. What's typically the thing that happens within the first year with that mortgage company that you closed with? What do they usually do with that loan?
Typically sell it to some sort of servicer.
Yeah, so they typically sell that loan, and that's because they want their money back as quickly as possible.
Mm.
And so when we think about the velocity money, and I like to use real estate as a perfect example of this, you can invest money into a real estate asset that produces income. When you receive that income over time, you're getting paid back that principal that you initially put into that asset. And so once you get that paid back in full, which ideally, if you can get that back within a couple of years, 2 or 3 years, you can now reuse that same money to invest in a different opportunity. And that's the investment. The velocity of money is where you're investing the same dollar multiple times over. And
Mm-hmm.
this differs from the accumulation theory in the sense that with the accumulation theory, you're putting your money into an account and it's just sitting there. It's not producing income. You're not getting multiple uses out of it. And so that money is not nearly as efficient as it could be if you maintained control and access of that money. And a perfect example of this was with my own dental practice. The first velocity money happens when I invested in my education to get a dental degree, right? I have a much higher earning potential now and a higher income that comes after I invest into my education to become a dentist, right? And then I also purchased my own practice. Now I'm putting more money in, but I'm receiving more money back out afterwards. And so that's another velocity of money that I experienced was when I purchased my own practice. My income level almost doubled. And then over time, I invested in the practice. I took CE courses, which cost money. I invested into my team members. I invested in system and processes in the office. I updated equipment, worked on the culture of the practice. And over time, we saw our, gross profit increase almost double within a few years by investing in the practice. And if you think about that, if that money was being put into something like a retirement account, would I have experienced that same sort of growth or return of my money? No, it doesn't happen.
Mm-hmm.
And so for us, it's all about investing in the things you know and control. So if you're a business owner, invest in your business. If you like real estate and you want to learn more about it, or you already do know about it, invest in real estate. You're going to experience far greater growth and taking advantage of that velocity of money and the efficiencies of the money when you invest in those types of things.
Okay, so when you get to this stage, this phase within the principles, if a client says, well, I really want to learn, I understand, and I want to learn more about the stock market, do you guys establish more of like a taxable or a brokerage account as opposed to purely retirement? Or because there's advantages with retirement accounts, obviously it's pre-taxed, at least for most of them. Do you guys have a process of kind of walking that client through so that you can satisfy the qualified side of the plan, but also have some opportunities for that client so that he or she could educate themselves further in something that they really enjoy?
Yeah, if you think about the traditional way that most people invest into a 401k or an IRA, something like that, most people will only put as much money in there as they receive a tax advantage for.
Mm-hmm.
And that falls way short of where they need to be if they really want to achieve financial freedom. The biggest thing that most people don't think about when they're putting money into something like a 401k is what's called opportunity cost. It's the cost of what that money could have done for you if you maintain control of it and invested in something that you know. And so for us, we typically actually don't normally encourage our clients to invest in something that they don't know or understand. And so when you think about a 401k, they don't have control of that money. They don't typically have access to it. They're afraid to pull it out because there's implications in doing so. And so it doesn't follow the principles that we talk about, which is maintaining that use and control of your own money.
It's interesting because, there's, at least from an investment standpoint, there's the passive side, there's the active side. Passive is kind of what you're talking about, set it, forget it. But then there are the folks out there that believe in the active side, but hearing you say you want to make sure that your clients have the control and they understand what it is that they're investing in. The active side of investing almost really shouldn't even be a thought with your clients, because you don't know what the active investor is doing, and you may not even understand what they're investing in. But you've got several thousands of dollars into these accounts that you're just hoping that you're going to get a good returns. It really feels like Unique Advantage's approach to financial planning is very unique, because it kind of starts with people just saving first, and then we have to get all the way to the fifth principle before we actually start to invest. And we're only investing in things that we want to invest in and understand. Is that kind of a good summary of Unique Advantage at this point?
That's exactly right. And when you get to that fifth principle where you're investing in things you know and control, that's up for our clients to decide what they're interested in investing in. So we don't typically advise them on, hey, you should invest in this or that opportunity. It's like, well, what are you interested in learning about? What do you
Mm-hmm.
want to become educated on? What do you want to gain experience with? And that's where that's going to take them. And they find success in it because it's something that oftentimes that they enjoy or they're passionate about, or they're willing to spend the time and effort to invest in that opportunity.
Well, this has been great, Eric. I mean, really, it's just been eye opening to, we always hear about, you want to make sure that you're, kind of in a state where if some unexpected thing was to happen, you're not going to put yourself into debt. We understand, we should have as much insurance as we can possibly afford. But really, just, what I'm pulling away from this is invest in what it is that you want to learn more about and that you're comfortable. And I feel like if more of us did that, the return itself may not be like the driving factor. I mean, we take on a lot of risk as retail investors to try to find the highest return possible, but may not understand anything about the company. And then when it starts to deteriorate or, fails to hit these percentages, we sell at losses and we move on to the next, shiny object. So it's just been really a pleasure to learn more about Unique Advantages, principles, and how you guys set your clients up for what I would think would be the ultimate of success, either during and frankly, probably a lot after they get into retirement as well.
Yeah, I love how you mentioned that. But really, our planning process is not just a system that we plug people into. It's really helping people become something more,
Uh,
to find more meaning and purpose in life.
mm-hmm.
It's a journey to become a better person, a better investor, have more understanding, more educated. So it's a very fulfilling process and journey that we take people on. And that's why it's very rewarding to be able to teach people about these things, because we see how it changes their lives. It
Mm-hmm.
impacts them greatly. And the very first thing we do when we sit down with our clients is we try to understand their concerns, but we want them to understand, why do you want to be financially free? What is that going to do for you in your life?
Mm-hmm.
And if they don't really understand the why behind it, it's going to be very difficult to be successful. So the most important thing they can do first is understand, why do I want to be financially free? What's that going to do for me, for my life, for my family, for others? How can I help other people? So I just love this process. I've known about it for 14, 15 years. I've been following these principles. It's actually helped me make the transition that I'm making today. I wouldn't have been able to do this if I wasn't following these principles currently.
Yeah. You're almost becoming an active investor in your own investments. Yeah.
Yes.
Right. Like you're doing it, not somebody else. And I'm sure that there's a lot of satisfaction that you get from your clients and so forth. Well, Eric, this has been an awesome conversation. How can people get a hold of you or learn a little bit more about Unique Advantages principles?
You're welcome to reach out to me anytime. My email address is eric@uniqueadvantage.biz. My cell phone, I can give you that as well too, 303-242-0277. Text, call me, anything. I'm happy to talk to you about anything that we do. Just happy to share more information. Just love being able to teach people the things that we know, and things that will help them in their lives.
Well, that sounds fantastic. Well, I really appreciate you jumping on our podcast here. Really love the conversation. So many good things came from it. But until the next time, I hope you guys are having a great day. And Eric, again, thanks for joining us.
Yeah, thanks, Neil. Really appreciate your time too.
Alrighty, we'll see you until next time.